In this video, I'm going to talk about adjusting entries. I'm going to talk about several types of adjusting entries and go through several examples. So I will probably do at least 5 videos on adjusting entries. First of all, what are adjusting entries? These are entries done at the end of the accounting cycle. Typically, this means at year end. And when you're doing adjusting entries, basically the goal of these entries are to record revenues in the period earned, to record expenses in the period incurred, and to update asset and liability accounts. Adjusting entries would be an accrual basis accounting topic. You would not do these for a cash basis business. However, I still recommend reviewing the books at year end if using cash basis and just making sure that things have been recorded properly. This is an overview of the types of adjusting entries that I'm going to talk about. I'm going to talk about deferrals, deferred expenses and deferred revenues. I'm going to talk about accruals, accrued expenses and accrued revenues. And I'm going to talk about depreciation. And then I also want to mention that there's something called an unadjusted trial balance. And this is simply a trial balance prepared before any adjusting entries are done. The idea is that you would review this trial balance, look at the balances, look at the accounts, and you would use it to review the books, and it would help you look for anything that needs to be adjusted. And if you don't remember what a trial balance is, it's just a list of accounts and their balances. You would run the unadjusted trial balance first, review it, look for entries that need to be made, then go do those entries, and then rerun it after everything is complete and make sure everything looks good. Okay, let's go in a little more detail about some of these terms. First of all, deferrals. These are income or revenues and expenses that are not recognized until a future date. In other words, typically what you're looking at is a situation where cash has already been exchanged. For deferred expenses, that means expenses were paid for already in advance. In other words, you're looking at prepaid expenses. You pay your rent for 6 months in advance. Insurance was paid for the year, those types of things. And then deferred revenues would be when a customer paid for a product or service in advance. And this is considered unearned revenue. In other words, it was a deposit or down payment of some sort from a customer. So that would fit in this category. And the idea here is that you would adjust, you would look at these things, you would adjust for anything that needs to be adjusted. For example, by the time you get to year end, you might have some money sitting in unearned revenue that has actually been earned. Or you might have some prepaid expenses that have expired or been used up. And you would just want to adjust for those things to make sure your financial reports are accurate. And then accruals are assets or liabilities on the books that represent some sort of revenue or expense that's receivable or payable. Or the easiest way to explain it is majority of the time you're looking at something where cash hasn't been exchanged yet. You have an expense that the business incurred, but they haven't paid it yet. That would be an accrued expense. You have a revenue or income that the business has earned, but they haven't received payment yet. That's an accrued revenue. And basically what this means is at year end, you're just going to look through the records and see if there are any expenses that need to be recorded in that year, or if there are any revenues that need to be recorded in that year. That's all there is to it. And I'll go into more detail later about these things and give you some examples. This is the first example that we're going to go through. I'm going to go through one example in this video, and then I'll probably make another video with more examples on deferred expenses. So a deferred expense is when an expense is paid in advance. A prepaid expense is an asset account. And the examples you'll see in textbooks a lot of times are prepaid rent, prepaid insurance, and then office supplies would also be treated in the same way with the same process. So the prepaid expenses, just to emphasize, the prepaid expenses are recorded as assets. And what we're going to do for the adjusting entry is we're going to look at what has been used up or what has expired related to that prepaid expense. Once that is calculated, then an adjusting entry would be made to transfer the amount that has been used up or expired, transfer it from the asset account to an expense account. And it may not necessarily be the entire amount, it might just be a portion of the amount in that prepaid account. So we're going to use the example of office supplies. When office supplies are purchased under accrual-based accounting, they are put in an asset account called office supplies. But then as those supplies are used up, that is more of office supplies expense. Expenses are things that you use, things that you pay, costs of operating your business, whereas assets are resources. Well, if supplies have been used up, they're no longer a resource because they're not there anymore. So the adjustment is to transfer from the asset account to the expense account. So let me show you that with journal entries. Okay, so let's say the business purchased office supplies for $500 cash. They would have debited office supplies and credited cash for $500. And both of these are asset accounts. So the one you're adding to, if you remember the debit credit rules, the asset you're adding to would be your debit, and the asset you're subtracting from would be the credit. And I put cash here, but it could also be the checking account. And then at year end, supplies would be counted to figure out how much was on hand and how much was used up. Well, if they counted and $200 of supplies were on hand, then you would have to assume that the other $300 of supplies was used up. It doesn't make sense to keep $500 in an account when now there's actually only $200 of supplies in the office. So you would do an adjustment to transfer the $300 that was used up to office supplies expense. So the original entry when supplies were purchased was a debit to office supplies, and now to subtract out of that account, you would do the opposite. You would do a credit. So you're crediting office supplies, crediting to subtract from the asset account, and debiting to add to the expense account. Let's look at this in T accounts. The original purchase was a debit to office supplies and a credit to cash. And then the adjusting entry was a debit to office supplies expense and a credit to office supplies. And then if you were to calculate the ending balances, office supplies would be left with a $200 debit balance because remember, debits and credits offset each other. So you would subtract, and the balance goes on the side that was a larger amount. 500 is larger than 300. So the balance of this account should reflect what is actually on hand. And then cash would probably have other transactions in there, but I just went ahead and put that 500 credit as a balance, even though normally asset accounts have a debit balance. But we're not focused on cash right now. We're focused on the office supplies accounts. And then for the office supplies expense account, now you would have the 300 over here as the balance to reflect that that is the amount of office supplies that was used up that time period. And basically, this is the process the company would do at year end to adjust the books. This is just one example. We'll go through several more examples in these videos. I hope this video was helpful. If you have any questions, feel free to comment below, and I'll see you in the next lesson.